Okay, hello everybody. Today's your Friday take on the market. Today's the 19th of November. It's in the middle of the trading day. I have something going on this afternoon, so I can't do this afternoon. So keep that in mind with some of the charts, and if something crazy were to happen with the markets. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at IBD. Here's the disclaimer. I am not licensed. I cannot tell you what to buy or sell, how many stocks you should own, et cetera, et cetera. So we will try to educate you on, kind of the way we've done it for, many, many years. And hopefully you can kind of learn to do it on your own. We'll start with the markets. We will go to the industry groups. We'll talk about some stocks. There's a lot of stocks to talk about. And then we'll have our quote. So I am going to kill the gauges, the traffic lights. Every weekend, I just get too many emails. People are confused. Like, what's the leaders? Why is the portfolio green? I don't know. I don't know why your portfolio is green, flat, or down. So it's just subjective based on how I'm doing. One of the things I love about working where we do is we definitely have skin in the game. We practice what we preach. I've been trading actively for 25 years, maybe 26, something. 1995 was when I first opened my own account. So all I can do is just give you kind of a gauge based on how I'm doing. So I just feel like it's just caused too much confusion. So I'm just going to crush that. If you liked it, sorry. It just was just too hard to explain, the subjectiveness of what I think the leaders are doing, or why am I up and you're down, or why am I down and the market's ripping higher? That could be the case too. So the market though is not subjective. At least we have some black and white rules based on IBD's big picture. So we'll just use that going forward. The big picture says the market's in an uptrend. I don't know how you argue with that. You might think it's too high. Fine, that's fine if you want to think that, but you cannot argue with the fact. The fact is the market's in an uptrend. So it makes it pretty simple. Let's pull up the charts. Here's the NASDAQ. We're making new highs as we speak today. Let me be the Debbie Downer, so to speak. The relative strength peaked at 14,175 here on the NASDAQ. And now the relative strength is here, much, much lower. And we're like, 10, 12, 15% higher from there. At least it's turning up a little bit. You've got kind of a short-term uptrend, but you do have kind of an underperformance in the NASDAQ. Partly, I think it's based on you've got Amazon. Let's go to the weekly. Hasn't really made much progress. It is, almost, or probably if this was the close, it'd be a closing all-time high, but it just hasn't gone a whole lot anywhere. Facebook in the last has underperformed. Nvidia has done really, really well. We'll talk about that one. And then Apple is breaking out of a base as we speak. So, but it's starting to perform. But, in the last kind of 9 months, Apple's gone from 140 to 159. I need a calculator. It's about 13%. What's the S&P done since then? Just roughly right here, 420 to 469. That's actually a little bit less. But so Apple's outperformed a little bit, but the overall NASDAQ is it's being held up by Amazon, Facebook, Nvidia, Tesla, of course, and holding up really well. There is some weakness under the surface. There are some leaders that have not have broken down. So UPST looks broken. It's down. It's broken. It's down 50%. I don't care what your objective is. I know if you bought it down here or here or here or here, you've done great. but you're down 50% off the high. So it needs a whole new base, a whole new reset. ARK is another fly in the ointment. This looks very, very tired. The relative strength is just putrid. Look at the relative strength. It's making new lows. If I were to drag this across, the last time relative to the S&P, ARK's RS line was here. The ARK was at, let's say 75, and currently it sits at 114. So it's being held up. It's like the reverse of a basketball underwater. If the S&P were to break, I think this would just fall apart, but it's not. It's hanging in there because the market's so strong. But this looks very, very weak. The S&P, new highs, IWM, no surprise, tried to break out, pulled back. It's kind of a weird index, but not acting terrible at all. So the markets are fine. They're in new highs. There's very little distribution. Now let's go back to the NASDAQ. Now, every once in a while you get, where you get this kind of sell-off. That was pretty nasty. It doesn't look like hardly anything now, but you get that. And if you're in these high octane stocks like we are, you can feel a couple of those bad days can feel pretty bad. So, I might take off some exposure. I might go from, if I was 100% invested, down to 80 and then wait. And if it keeps going down, then I would be, 60, 40, 30, 20, 10. Eventually, if we get something really bad like this, it's just going to drag you out. It's going to drag you out probably close to cash. Someday we'll have a bear market. Here's a monthly chart of the NASDAQ. So I lived through this one. I don't know how anyone could sit through this. In fact, honestly, I don't think anyone could, just except long-term investors. The great financial crisis looks like nothing now. It looks like just a blip, but that was like 50%. Here's the original COVID break, which was like 30%, looks like nothing as well. So we will have a bear market. I don't know if it's next week, next month, or 5 years from now. I have no idea. But I do know the signs will be there. You'll see the signs. Stocks will go down and they'll stay down. So when stocks go down like this, I tend to do some selling. It's like protection. It's like insurance on my portfolio. If I go from 100 down to 80 and I'm wrong, no problem. I'm still 80. I can always add more exposure back if I want. But if you break again, then I go down to 60 and I'm wrong, no problem. I can always add more exposure, but I'm just going to keep paying those premiums. It's like insurance on your home, right? Like Bill talked about. I've owned my home for 20 plus years. I've never made a single claim on the homeowner's insurance. So I've thrown away all those premiums in hindsight, but I will continue to make the payments. I have earthquake insurance because earthquake insurance is extra here in California. If we have a big earthquake and my home becomes uninhabitable and I don't have insurance, I'm going to have to write a very big check to replace it. I don't want to do that. I'd rather write a small check every month or every year or every 6 months, however I do it. Can't even think of it. So that's what this selling, when I reduce my portfolio, it's like writing a small check to protect my overall portfolio. And I hope I'm wrong. I hope that it comes back. I hope it keeps coming back. I know one time it won't. I know that unless they've outlawed bear markets going forward, we will have something like this. And I won't be able to survive it. I know that the markets come back. They almost always come back, but they don't have to come back, and they could stay down for a long, long time. So I would rather just write the insurance check like I did in the late 90s and 2000s and like I did in 07, 08 and just wait it out and then find a spot to get back in, whether that's here or here. You might get some false signals to get back in, but we have signals to help you get back in. And so a lot like the COVID crisis, I get out and then I have to get back in. A lot sooner than I expected, but that doesn't matter. I don't want to have any expectations of what the market's going to do. So that's how I think about managing my portfolio and the wiggles. I know Ross Haber, who's a former portfolio manager, was on the podcast yesterday with Justin and Arusha, and he says he's very rarely is he on margin, and he's always kind of reducing his exposure in these types of situations. You know, I don't know exactly how he does it. He talks about it. I'd listen to the podcast, but the idea is the main thing I want to say is you don't really have to be fully margined to get good performance with the types of stocks. You have to have rules, portfolio management rules. You got to be a tiny bit concentrated in them at a minimum. You don't have to be Charles Harris and have your whole account in Tesla, but you might want to have 10, 15, sometimes 20% position in a name. If you have a bunch of small 1% positions, you can't really move the needle if you get something right. And then you want to have sell rules, and that's the hardest part, so that, you know, somewhere you get out of UPST, even if you have to get out of it like this, or somewhere you get out of Peloton, you know, even if you have to get out of it like this, or somewhere you get out of StoneCo, even if you have to get out of it like this, way off the top, because 95 to 70 is brutal. Let's say you bought this, you know, here, 95, and this looks, let me make that. So let's say you bought StoneCo here at 40, you watched it run to 95, and then it breaks to 70. It's no fun to take 70, but 70 is an absolute incredible price compared to what's going on now. And it can happen to anything. Like Visa's quickly down 20%. So this is the hardest part, is to have sell rules. Yeah, because if you want to have a big winner, you know, if you're going to have an NVIDIA, something like this, you're going to have to ignore some sell rules, because you might have a sell rule there. You're definitely going to have some kind of sell rule there. This looks like a nasty reversal, et cetera, et cetera. So it's going to be hard to know which ones to ignore. Maybe you take a little bit off and then you see if it can come back, which is the way I prefer to do it. The industry groups, no real changes here. It's retail department stores. What's driving that? DDS looks very climactic to me. Doesn't matter what I think. It just goes up every week. If I was in it, I would definitely have been selling that week. I'm not in this one. That's driving department stores. Energy coal, that group made such a good move off the bottom that the group strength is still really strong. I mean, this is 3 to 10. That's a triple, but it's 20 to 10 off the high. So that group looks broken. I think it's going to gradually move its way down. Semiconductor fabless, that's NVIDIA. Auto manufacturers, that's Tesla. Lucid is acting good. Race, Ferrari is acting good. Security software, Zscaler is leading the way. CrowdStrike is just okay. It's not terrible. Energy solar, that's Enphase, and so on and so forth. So it's the same stuff that that we're aware of. Stocks to watch. Let's talk about Apple. It broke out of a base, acting pretty good. The relative strength ain't all that great. Ain't all that great. Is that good English? No, but we're gonna go with it. It's too late. I can't unrecord that. It's not, the relative strength is not as strong as you'd like, but it's a pretty good pattern. I'm kind of mad at myself that I didn't buy that, because that's really tight action. Look at the action in that. So that looks really good. NVIDIA, you know, it's a little extended, I think, but it doesn't matter what I think. It's the leading stock in the market as far as big. It's kind of, you know, might argue Tesla as well, but I feel like NVIDIA has kind of taken the role of Tesla in the last few weeks. And then last but not least, the smaller trading, fastest moving stock is Roblox. Super breakout. I think I talked about it last week, right? I thought it reminded me a lot of the Microsoft chart. And now you have your power from pivot. up 34% in 3 weeks or less, in 2 weeks, excuse me. And now you have to decide what are you going to do with it if you own it. If you want to use the 8-week hold rule, then you do nothing. So if it goes to 160, you do nothing. If it pulls back to 125, you do nothing. You just, it kind of makes it easy, sort of. At least you know what you're going to do. You do nothing. I wouldn't let it come all the way back. So if you own it at, say, 100, I'd probably be out by 105 if you're going to use that rule. Shouldn't come all the way back to 105. Maybe even a little bit more, but you have to give it some wiggle room if you're going to try to hold on to it. It's, in the short term for somebody like me, it's very extended, gapped up yesterday. That would be a sell signal. Maybe I'm not going to sell it all. I'm definitely going to reduce and just kind of watch, because I know they wiggle around. They do all kinds of things to make it difficult. And it's just, I just want to make sure the right position size. I want to have enough that it makes a difference if it keeps going, but not too much that I can't handle the volatility. And that number is different for everybody. So the quote of the week is from Larry Williams. He was on a podcast on YouTube. I was watching the video. He's an author, commodity trader. He's been around for a long time. And he says your bet size should be a fixed percentage of your equity. So when you're entering a trade, you should always know exactly what percentage you're going to use, whether it's 1% or 20%. It's probably somewhere in between. I think 1 is too low. I definitely think 20 is too high. I like to use 10%. It's just an easy number. Honestly, sometimes I hesitate with 10 if the stock is smaller, not as liquid as I'd like. I get that calculator out and it's like, whoa, that's a lot of shares for the way that stock trades. I might change my mind. I might go 7 or 8%. But if it's NVIDIA, Apple or something, it's simple. It's 10%. But pick that number for you based on your risk tolerance and how you handle it. You really should kind of go back. I think a few videos ago, I mentioned I had a 40% position in something, and it just was just too much. I just was watching it too much. So I just cut it in half and just said, that's just being greedy. I really, envy the way Bill could do it. He could have all his money and be on margin in a single name. I just can't do it. I just can't handle the stock right. So it doesn't do me any good to have all that size. It's better to have smaller size and capture more of the move, because there's less risk. I have smaller size, less risk, capture more of the move. Sometimes I find that you can, when I take some off, I make a lot more money on the position that I keep to let the stock run than I did on the initial trade that I took some off, because I allow the stock room to breathe and run. So think about your bet size, and pretty much you probably want to do the same every time you do something. As your account grows, your bet size increases because it's a fixed percentage. If you get into a drawdown, you're not trading very well, then your bet size should decrease, which is perfect. You're flowing, you're ebbing and flowing with the market. Okay, everybody. Next week, I don't know if there's going to be a video on Friday. Probably, but I don't want to guarantee it. It is a holiday week. The markets close Thursday for Thanksgiving, and Friday the markets open half day. I think we close at 10 o'clock Pacific time. Have a great holiday, everyone. And if there's a video, we'll talk to you next week. Bye-bye.